This episode of From Angel to Exit is brought to you by the CEO's Right Hand. The CEO's Right Hand provides customized outsourced finance, accounting, and human resource services tailored to small and medium-sized businesses. Their services include fractional CFO, HR support, capital raising, and financial infrastructure development. They emphasize personalized engagements and expert support to drive growth and operational efficiencies. If you want to find out more, visit theceosrighthand.co. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Todd Taskey. He is an MA advisor. He's also an angel investor with many companies. I'm excited for this conversation. Todd's had a lot of experience in this space, has a lot of, I'm sure, stories and insights, things that he's seen both personally and with the companies he's worked with, around the exit process, around the growth process, post-exit, and the things we can learn. So I'm excited for this. Todd, thanks for being on the program.
Yeah, Bruce, I'm super happy to be here. Thanks for having me.
Yeah, no, it's a pleasure. So before we get into all the work you're doing today and kind of the work you're doing with exits and M&A, let's get a little background. Like, how did you get into this space? What was your business background? Give us the story.
Yeah, it's not super exciting. I spent 20 years as a financial advisor. I was a certified financial planner. I built a small business. We had 100 and something million of assets under management, which is relatively small. We sold it to another group that was eventually acquired by Goldman Sachs. I had always worked with entrepreneurs. And, kind of one thing led to the other, and a couple of people had asked me to help them during transactions, and I had learned about how to do deals that way. And when you do deals with individuals, founders, it's different than doing them with a board or a bunch of investors or something of that nature. So. Yeah. There's a little bit of art to it. There's a little bit of science to it. The science being the math and the numbers, and the art being all the other things that are so important to clients. I think, as you know, most of the transactions that we do involve a client focusing on a second bite opportunity, which I'm sure we'll talk more about.
Yeah.
So it's not just how much cash can I get before I leave. It's about the right amount of cash, the right amount of equity upside, the right partnership, the right alignment of personality and skill sets and all that other stuff. Yeah. And that's what makes it, a little bit more intriguing and interesting to try to put together.
Yeah. I always say they're a bit of a puzzle. Can you get all the pieces to fit together to make something pretty?
For sure.
Yeah. So let's talk a little bit about kind of this world of exits, because I think, everyone talks about exits and, selling your companies and things, but there's so many different kind of ways or kind of, configurations of this. Like, how do you kind of look at the landscape of, M&A or kind of how people exit, and how do you kind of group them and categorize them?
Yeah, so let's take into two sets of two groups, right? So the first group is in an exit. What do you want to accomplish? Do you want to leave? Do you want to exit? Or do you want to accelerate, is how we look at it.
Okay.
And most of our clients want to accelerate. And they use that in a couple of different ways. The factors there, which delve into the second part, is the currency that a buyer will use.
Okay.
Because there's three forms of currency in a transaction. There's cash, always our favorite. There's equity, which eventually could be more valuable than the cash. And then there's earnout. And it's the combination of those three things that are the consideration that a seller will focus on. And there's many things that we can talk about in there. So the question really starts from, what is it that you're trying to accomplish? And I'll give you, two just quick vignettes.
Yeah.
But we sold a and we talk about a lot of these things on our podcast, Bruce, which is called the Second Bite podcast.
Yep.
And so we did a transaction. I got all these trophies over here, but we did a transaction with a company called Digital Impulse. Okay. And Andrew Kalidas was the founder and the CEO and the majority shareholder there. And he talks about it on our podcast, and he says, this was me fulfilling my growth plans. And so when I sat there and I looked at all the things I want to accomplish, I don't know that I was the right guy to build it all from scratch. And so we found a really good fit with them with another company called Demand Drive, where all of those pieces that they had were just perfect for what Andrew was looking for. And Andrew was a perfect fit for them. Shared vision and on from that standpoint. So he got a bunch of cash at close. He's got a bunch of equity. He had a small earnout, which he's in process of getting now over the summer. So that worked really well for him. And now he's part of the executive team of a larger group. Okay. There's a company called Social SEO back in 2019. We did a transaction with them. They were $2 million of EBITDA at the time. Okay. On $10 million of revenue, really well-run business on and on from that standpoint. And they partnered with private equity. Okay. And so they got a bunch of cash as well. They had a small earnout. And then they kept a bunch of equity in the business. That business today is, north of 15 million in EBITDA. They've made 4 acquisitions, and they've built all of that business in their image and likeness, as I would say. Mm-hmm. And the pieces, the puzzle pieces they put together, the other capability sets they acquired, and all those things, they mold it, and they're still CEO of that business and still growing it and having all those pieces. I've got a lot of guys that say, listen, if I could sell this business, get cash and equity, and just go back to selling stuff, just go back to pleasing clients, bringing it home, dropping it off, not worried about utilization, not worried about, not worried about accounts receivable and balance sheet and all this other stuff, I would be thrilled. Yeah. And so it's part of it is just designing all of that for what the next 3 or 4 or 5 years will be like for our client.
Mm-hmm. Yeah, I always find it's fascinating to sort of find out how many business owners did not anticipate being business owners or have gotten into that state and realized they really don't like it.
And you know what else I find, Bruce, is that there's a lot of guys and women, that I hear, they say to me all the time, I didn't know I could do this. Yeah. I thought if I sold the business, I had to go find a job or go do something else. Mm-hmm. But the notion I could sell my business and be part of a bigger future and do it with new cash in my pocket, less risk in the future, all those kind of things, is a better option than remaining independent.
Yeah. Let's kind of parse out kind of the nature of some of these deals, because I think that gets complicated for a lot of folks, and I'd love to kind of get your understanding or see how you take it. You mentioned these 3 pieces: the cash, right, which is little money you're going to get on signing, and then earnout, and then equity. Let's talk about the earnout, because I think that gets a little confusing for folks. Like when you're looking at earnout options, like how much of this is basically just a deferred guaranteed payment? How much of this is, how is it collateralized or backed up? Is that, how much of this is at risk or variable based on performance? When we're like, give me kind of the world of earnouts that you see.
Yep. So those are great questions. So typically people will describe the earnout as a way to bridge a gap between the seller's expectation and what the buyer's willing to pay. Okay. And that really depends on how you set it up from the beginning. And if there's one takeaway from this for your listeners, I see people hurt themselves all the time before they even start marketing their company in what they put in their deck. So let's keep it real simple, okay? And let's just say that you've got a company and it's doing $2 million of EBITDA, and they're growing 15% a year. We're in the summer of 24. So they're projecting 25. Mm-hmm. Rule number 1, whatever you put in for 2025, nobody believes it. Nobody believes it at all. I don't care if it's good or bad or tremendous or terrible, right? But what people do all the time is they say, okay, we're growing 15% a year. Let's tell them we're going to grow 30% next year because people will get excited.
Yeah.
And they don't get excited because they don't believe it. And they're not buying your business for what it will do in 2025. They're buying your business for what it is today.
Yeah.
So then they get an offer. And the offer comes and it's got cash and equity and a little bit of earnout. And you say, well, what do I got to do to get the earnout? And the buyer says, you know, I just want what you put in the deck.
Yeah, I want the 30%.
I want the 30%. And you're like, holy shit, now I got a problem, right?
Yeah.
Now I got to go get 30%. So I'll tell you this. We have plenty of clients, 30% growth a year, for real. Mm-hmm. When we project 2025, 15% growth. Mm-hmm. And this is one of the only things I coach my clients on what to say. Because the buyer eventually says, wait a second, you're growing 30% a year. Why do you project 15 next year? Mm-hmm. And my client says, because that's what we always do.
Yeah.
We always project 15%.
Yeah.
And then we work really hard to try to do better than that. Mm-hmm. But listen, we're a $10 million or $15 million agency. We don't spend time doing projections. We don't do forecast analysis. We don't do all that stuff.
Yeah.
We work really hard to make our clients successful, and then the chips fall where they may. So I always project 15%.
Yeah. Well,
That's
how does that affect the numbers though? Because if it's, you're creating a safe projection, mm-hmm. But then they're going to do a valuation based on their projection. Aren't you leaving money on the table? What happens if you do 30?
Yeah, great question. So most buyers in this space are not going to make an offer based on your projection. They're going to base it on your historical. They're going to base it on your TTM, your trailing 12 months of EBITDA. So from that perspective, that's what they're really going to use. And if it's a good growth story means the prior 3 years, not what you're going to do next year. Mm-hmm. Then they'll increase the offer. They'll be at the higher end of the range, whatever the case may be.
Yeah.
If you really think you're going to do 30%, there's ways that we will build into that to be able to accomplish that. Mm-hmm. But you'll never leave money on, and maybe that's the mistake that folks make, or the reason why they think they need to project something bigger. So that's the first thing on the earnout. The second thing is this. Let's say the earnout is $2 million, okay? Mm-hmm. And $2 million is a lot of money. People, individuals, buyers, sellers do weird things for a lot of money, right? So how do we eliminate that? Well, I'm going to make up numbers that'll keep it easy. Yeah. Let's assume that last year you did $2 million of EBITDA. And so we're projecting, I'll use 20% because it's easier math for me. Uh-huh. We're projecting $2.4 million of EBITDA for the next year. And if we get $2.4 million of EBITDA, then we get our earnout of $2 million. Mm-hmm. Okay? So that's what's known as a cliff. You get the 2.4 and you get the 2 million.
Yeah.
If you come in at 3.9 as the buyer, we win because we don't pay you anything.
Yeah.
And nobody wants that, including the buyer.
Yeah.
So we say, listen, there's from 2 million to 2.4, that's 400 grand. 400 times 5 is the 2 million for our earnout. Mm-hmm. So our hurdle rate now becomes $2 million next year. And for every dollar over 2 million, we get $5. Okay. So if for some reason you come in at 2.3 million, not 2.5, you take the 300 grand, multiply it by 5, it's 1.5, and you got 1.5. Mm-hmm. But you didn't get zero. In a better world, and it all depends on the negotiation, I'd like to start the earnout at 1.9 million and take it up to, so now there's 500, so it's 5 times $4. Yeah. We're going to get some more certain, blah, blah, blah. And all of that works its way out when you're negotiating in the LOI stage. Mm-hmm. And if you have more interested parties in that stage, it's easier to negotiate a better outcome.
Yeah, just because you've got competitive bids or basically parties that are willing to kind of juice
and
their
that's
offer
how you make earnouts work.
Yeah. And how, I guess, the funny thing I always find about earnouts is you're basically continuing to operate the business for somebody else. Like, how do you kind of get through that? Well, why shouldn't I just keep them? Why shouldn't I just keep the business, right? Why bother selling it if I'm essentially at risk for my money, just like I would be at risk if I kept the business?
Okay. So I'll go through a fictitious example that's going to be pretty close.
Yeah.
Let's say the value is $10 million. Let's just say you're like $1.8 million of EBITDA. So if we take 10 and we divide it by 1.8, you got 5.5. So let's say you're 1.6 million of EBITDA and you got 6.5 times or something like that, right? So you're 1.6 million of EBITDA and we sold the business for 10 million bucks. On the 10 million, I'll make these up. You got 6 million in cash. Mm-hmm. You got 3 million in equity.
Okay.
And you got $1 million in an earnout to be paid over the next 12 months.
Yeah.
Okay. So from that standpoint, you got $9 million worth of consideration at close, which is what, 5 times your current EBITDA.
Yeah.
That's pretty good. Most private equity groups, most buyers will underwrite their investment in an agency to perform somewhere between 3 and 5 times on their equity investment. So depending on when you get in, I would like to think that 3 million might be worth 9 million in 3 or 4 years. Mm-hmm. It's pretty hard, as you know, to destroy value, to have it be worth less than it is today. And it depends on when you get in. But I would think that there's a significant upside. If you feel differently with this buyer, then maybe we'll go to the other buyer, again, if we've done a good job and we've got multiple interested parties. Mm-hmm. Or maybe we'll go back to that group and say, I need 7 in cash and 2 in equity. Right? That's all just part of the negotiation. Yeah. So from that standpoint, I think when you think about the equity you roll forward into a deal, there's no tax consequence on. Yeah. The 1.6 million you're paying ordinary income tax on in many cases, mm-hmm. and then you get a capital gain rate on the equity. But to your point, here's one thing that I think works really well a lot of times for clients. I'll go back to our example, 1.6 million of EBITDA. The company's profit is like, let's call it 1.85. Mm-hmm. But you're going to continue to pay yourself 250 grand. Yeah. And 250 grand's fine, but it's not $1 million something like I was, right? So from that standpoint, it's nice to know that it's nice to know, number one, I got 6 million of cash sitting in my bank account. Number two, it's nice to know I'm going to get another $1 million at the end of next year, right, to kind of replenish my coffers from that standpoint, so that my life works on $250,000 a year until we exit this business.
Yeah. How much, it feels like a lot of these exits are kind of one of two camps. Either it's like I want to reduce my risk or kind of get out of the business or have, change my lifestyle to not be trying to, run and operate a business. Or there's this, I'm just feeling like we could do more, better, faster, and I need the right people, the right capital, and I'm not growing fast enough to do it on my own. Like, it seems to fit in one of those two buckets. Otherwise, it's like, okay, well, let's just keep running it. If you're profitable and you're making money and you don't mind running the business, keep running it.
Yeah. And I say that all the time. Go back to our same example, if you're making $1 million, $1.5 million, dude, you are a winner at life. Yeah. You've created jobs for a bunch of people. Yeah. You're doing great work for customers. This is fantastic. I would like to think you're making that much money and enjoying everything about, or most of the things about what you're doing. If you're not, then we can talk about that. Yeah. But so you're only growing 10% a year. If you're happy with that, then you're happy with that. Yeah. You don't have to make excuses to anybody. Yeah. At some point, though, I find people, and I get this all the time, where I talk to guys and they're like, listen, man, I'll do earnout for a year, maybe, and then I'm out. And then we start talking to a bunch of folks, and they're like, you know what, though? Those guys, they're pretty good, man. I would stay on board with them for a while, right? Yeah. And it rears its head in, I might take $3.5 million in equity. I really like them. I think they're, and then the private equity group, they've done a whole bunch of great things, and I like the team here, and gosh, the platform they have that they're building. If I had tools like that, I would kill it here. You know what I mean? And so guys get reinvigorated when it's not just another 10% or 15% growth per year, right?
Yeah, there's a vision in place.
Yeah.
Yeah. And let's talk about the equity side, because I think that gets a little confusing for folks at times. When you're talking about taking equity or keeping equity, I guess what are the different scenarios, and particularly the ones where it's, well, we're basically just going to keep operating the business. I now have an investor, maybe a private equity group or something like that, where they're taking ownership, they're infusing some capital potentially, but it's basically just the same business moving forward for the most part versus, yeah, we're doing acquisition. Someone's rolling us into something else, or we're getting part of a larger company. Like, how do you kind of think through, like, what does equity really mean, and what are the different types of equity that you need to think about? It's
such a good question, and I'll give you kind of 3 tiers of that. First, I'm going to call them the aspirational guys, right? Okay. Like if we put you and me and Steve together, now we'll be at 5 million of EBITDA, and we'll all be more valuable, and this will be great, and we'll divide it all up, and blah, blah, blah. And, we don't do those, and they're fraught with peril, and they never seem to work out well.
Drama, lots of drama.
A lot of drama, a lot of all that stuff. Let's talk about working directly with private equity. And here's one great takeaway. Use an example. I'm going to buy your business for $10 million. I'm going to give you 7, and you're going to roll forward 3. Mm-hmm. So that means I own 70%, you own 30%. Yeah. What the buyer doesn't tell you in this example is that I actually went and borrowed $3 million. Yeah. It's debt on the business that we're going to pay back because we own the business together. Mm-hmm. I put in $4 million. You put in 3. 3 out of 7 is 41.6%, not 30%.
Yeah, classic.
A real private equity partner will share in the leverage of debt. And you have to ask that question. Mm-hmm. And you shouldn't have to. Because your private equity partner should say, listen, Bruce, we're in business now.
Yeah, exactly. Yeah.
Now, you're going to get all 7 million of the, and we're going to use the debt to give it to you.
Yeah.
But you're going to have 41.6% of a business, and I'm going to have the balance, and we are going to pay off the 3 million over time. For God's sakes, we're just going to pay it dollar for dollar plus a little interest. That's the greatest deal going, right? Yeah. And it's so interesting because most of the guys listening, most of the people listening to this podcast probably don't have debt on their business. Yeah. Why? Not a fan of debt. Okay, let me explain it to you. We go through just that and like, Now, here's the biggest thing though. That debt on the business is debt on the business. I didn't sign for any of it.
Yeah.
Right? The private equity firm is putting cash. They arranged the debt. They competed the debt lenders. They've managed all of it.
Yeah, this is what they do. Yeah.
You know what they want me to do? Continue to go build the business. Mm-hmm. Fantastic. That's what, like the guys at Social SEO that I mentioned earlier, that's part of how they grew such a big business and why they still own so much of that business. Mm-hmm. So from that standpoint, if you partner directly with private equity, it should be that. It should be a real partnership, and they should be open and transparent about all of that stuff. So don't fall into that, here, I'm giving you a check for 7 and you'll roll forward 30. Because the point is, and this is now at the largest level, and we did 2 or 3 of these deals last year, where we sold a company to Agital. Agital's a private equity backed by Trinity Hunt. Okay. Trinity Hunt's one of the great names in private equity. They do what's known as a 419 valuation. I think they do it twice a year. Maybe they do it 4 times, but at least twice a year. And because they have to report to the fund shareholders. So they will say Agital started as this is all approximate, started as $1 a share, because that's what we said. Mm-hmm. And then the last valuation, I think when we did this deal, my client got in at like $1.62.
Okay.
How do you come up with $1.62? we get a ream of stuff like this, right? All sorts of spreadsheets and calculations, and the debt's in there, the value's in there, the multiples in there, all that kind of stuff. It's not, we're valuing ourselves at 100 million and we're valuing you at 5 million, so you get this little sliver. No. It's all transparently disclosed at close, actually well in advance of close. But that's the level that you should be involved in. And when you're involved at that level and you get off of those calls or come off a screen, you're like, those are the guys I should be in business with.
Yeah.
The level that they're talking about is what I need. I understand now why private equity always wins. God, they're smart. Plus, they have money. You know what they can't do? They can't do paid social real well, and they can't do SEO, and they don't know how to build content, right?
Yeah.
So when we combine these things, man, that's when the magic is made.
Yeah.
And when people get exposed to some of this, they're like, man, I want to be a part of it.
Yeah. Yeah, let's dig into the private equity stuff a little bit more, because I find it is such a, at least common thing for people to consider or think about how they're going to exit is go private equity. And obviously it is a fairly significant part of the M&A market is the private equity route. You mentioned how to kind of calculate equity and how to kind of deal with the debt. What are some of the other things you need to kind of be wary of or understanding or look for in a private equity deal? I'm thinking of things like management fees and, how they, class of shares and things like that. Like what are the things you're looking for in a private equity deal?
Yeah, so there's a couple different versions of private equity. And, there's also what are known as fund-less sponsors. Okay. There's very typical traditional private equity. They own a fund.
Yeah.
And they charge that fund, what's known as 2 and 20, and they get a management fee from the investors. And so they typically don't take a fee on an annual basis, but they will take a success fee out of the deal, right? And then there's other we can call them private equity guys, if you will, and they will work with many different financial sources, family offices, other private equity groups, and the rest, and they'll put it together on a deal-by-deal basis, okay. And they'll take a management fee from the company, but they'll actually work in the company. Okay. There's other larger private equity groups. I mentioned Trinity Hunt, the guys at Everlane, the guys at Mountain Gate, the guys at Gemini. These guys have resources. Mm-hmm. They have people that will outreach acquisitions for you. They have in-house finance teams. They have all the HR people. They have all sorts of stuff that they'll make available to all their platform companies. And so you become more robust and you become better and all those things as a business, not as a service provider, but as a business. And so from that standpoint, when you deal with private equity, there'll be some different flavors from that standpoint. And maybe that's why it's helpful to have a guide to help you understand what version of what it is that you're getting. Yeah. So that's how I would answer that.
No, it is a complicated world. I mean, when you're looking, when you've got a client, you've got a deal, a company that wants to do a transaction, exit, and you're looking at the private equity world, is there anything you're looking for in terms of types of private equity companies or where they are in their fund or things that kind of help you figure out where the best opportunity for that transaction might be?
Yeah, that's great. A really insightful question. So not so much at the fund level as it is in the investment level. Okay. So when we run a process, we'll get a bunch of different offers, let's say. And depending on the size of the business, and if you're 3 million or higher in EBITDA, mm-hmm. you have the ability to connect directly with private equity and grow out that business in your image and likeness like we talked about. Mm-hmm. If you're 1 million or 2, you're going to be a tuck-in to somebody else's strategy, right? And then you'll play a significant role in the future of that business. So if you're a tuck-in at any size, I just did a tuck-in over the summer. My guys were 5.2 million of EBITDA. Okay. So they fit into a larger group. The question typically when private equity makes a platform investment, they're going to underwrite that, like I said, for 3 to 5 times return. And they're going to underwrite it for about 5 to 7 years, in that range. The group that we sold over the summer, they're in year 5. And so what that means is in the 3 to 5 times, most of that's been used up because they've been performing well.
Yeah.
But they're probably going to do a transaction the next year. Mm-hmm. And so the equity that my guys have rolled into it, they'll get some upside on that, but they'll be free agents in a year or so.
Yeah.
There was others with that group that we looked at that literally are just getting started, or just they will be the first tuck into that. So that means I'm going to be around for 4 or 5 years.
Yeah, exactly. Yeah.
Also means I'll probably have more time to get 3 to 5 times on my money.
Yeah.
Right? And so from that standpoint, that is important. And those are conversations that you have when you talk with whoever the buyer is, whether they're private equity backed or not. Private equity plays a major role now in particularly in the digital marketing space, driving transactions. And so on our podcast, we did a great interview with a gentleman, Grayson LaFrenz. He is the founder and the CEO of Power Digital. And we've been fortunate. We've sold a couple businesses to them. Mm-hmm. But they did a deal a bunch of years ago with Periscope Equity in Chicago.
Okay.
They were about $5 million of EBITDA. And these are all numbers on the podcast, so I'm not telling tales. About $5 million of EBITDA. In 3 years, they went from 5 to 30 million of EBITDA.
Wow.
And they sold to another private equity group called Court Square.
Okay.
The private equity guys, the management team, and the early tuck-ins, 13x on money in 3 years. Home run. All of the management team stayed on board. Grayson is still there. Most of the executives are there. And they're building for a bigger exit. Also maybe a third bite exit, right?
Yeah.
And they're very focused on that. The people at Court Square are great. We sold them a conversion rate optimization business. We sold them a data platform business. So that's what they're doing, right? And so what will happen at the transaction stage, the second bite stage, is that typically at the level that our clients are involved in the new buyer, they'll be involved in the management presentation when they're out talking to new buyers.
Yeah.
And then that buyer will say, listen, Bruce, what do you want to do? You had 3 million of equity. Now it's worth 8. What do you want to do? And you're like, man, I love the vision you guys talked about. I want to stay on board. Mm-hmm. What do you want to do with your stock? I'll take half and I'll roll half.
Yeah.
All right, great. I'll take 5 and I'll roll 3, whatever the math on it is, right? Mm-hmm. Then, so let's say you take 3 and you roll 5. A year later, you're like, you know what? It is not nearly as much fun as I thought it would be. Plus, I'm richer now and my tolerance is really low.
Exactly.
So you leave.
Yeah.
There's a couple of things. Number one, I expect like you'll leave as an adult, right? So
hope.
You're not going to give a 2-week notice.
Yeah.
You're going to say, listen, this is summertime. I'd like to figure out a way I could leave by the end of the year.
Yeah.
Let's find my replacement. Mm-hmm. Okay. Secondly, in most cases, your equity stays. You get all that upside, right? So when you roll money in, they want you to stay. They need you to stay to really, it doesn't mean you're locked in just because your equity is still there.
Yeah.
So from that standpoint, there's all those considerations to think through and then to document and then to make sure you're protected well for the things we could anticipate and then all the things we can't anticipate.
Yeah. Yeah, I do find it's a bit of game theory, right? Like you have to think about, okay, what are my options? Well, if I do this, then this happens and this happens. Okay, what's the outcome there? And you kind of have to just go through all the scenarios and make sure whatever deal you ink, has reasonable paths on each one of those that allow you to make good trade-offs. Because I think
Right. Now,
the worst situation is feeling stuck, right? People
now
do
take
these deals
that,
and then you're stuck.
all that dynamic,
Yeah.
and then add another layer on top, which is the people.
Yeah.
Because all of that with those people feels differently than with those people, and definitely different than with those people. And so you have to go through those, right? Because there'll be some people who say, listen, the only way I sell to that guy, he's got to give me all the money in cash.
Exactly. And then I never want to see him again.
Right. So, and I don't know, if you have options, you just never pick that option, right? You pick the option of the people you want to be in business with. It creates a good home for your people, creates quite frankly, a better home for your people. Mm-hmm. And that's the one other thing I would say too, particularly in the digital marketing space. In this business, it's getting more complicated. Yeah. Right? All of it's trickier. AI is going to have an influence in it. Sure. The way that everything works is becoming more complicated. And you're, for people listening, you're doing a great job with your agency. But there's all this other stuff floating out here where other people are not standing still. Other people are creating the things that they are experimenting with and software for their customers. And the competition is getting harder and faster and stronger. Yeah. And you've got to be ready for that. Yeah. And so, it's interesting. We did a transaction. It was one with Power Digital. And our guys built a great data platform. People at Sproutward. Great data platform. So large D2C brands could ingest their first-party data and then buy media more effectively so they get a better rate of return on their investment spend. Mm-hmm. And Kevin, also on the podcast, Kevin Biondi, he said, listen, and we did this two years ago or so. He said, we have great software, really good. Next year, it's going to be pretty good. Yeah, exactly. The year after that, it's going to be the same that everybody else has. Yeah. Unless we spend a crap load of money to keep it current and better and all that. And I don't want to, it's my money, man.
Yeah, exactly.
I don't want to keep doing that.
Yeah.
Right? And that was a wise choice for them, future looking, that really, I think, at Power Digital, they've done really well. They like it a bunch, and they're focused on, the things that are creating highest and best use for them.
Yeah. I'm curious, when you meet a founder, an owner who's interested in selling, and you start talking with them, what are the questions that you're asking, or what are the things you're kind of using to assess how ready they are, both from the business point of view and personal point of view? Like, what are the things that you are kind of wondering or trying to get from them?
Yeah, I would say this. We sold that conversion rate optimization business. Ned McPherson, also on the podcast. Ned's great. I get introduced to Ned, and he's like, yeah, I'm not interested in selling right now. I want to do these things. And I said, listen, I know 3 groups that really want conversion rate optimization. Mm-hmm. Let's talk to them. Because all you're going to do is learn about what they need and why and this and that. And so he gave me a Loom video of him doing an audit for a client on their website. Gave that to 3 groups. We had 3 phone calls, one with each group, and we got 3 offers for that business. Yeah. And what I've learned over time is that if somebody can get a chunk of cash and still have equity upside, and solve their biggest business problems. And that's always a fill in the blank. It's different for different people. Mm-hmm. Ned was a sub $10 million revenue business selling to large D2C brands. Okay. That's hard. Takes me a long time. Takes me multiple calls, blah, blah. I talked to Ned. We did that transaction 7 or 8 months ago. I talked to him last week. He's like, Power has 220 customers, number 1. Number 2, they've got like a dozen salespeople.
Yeah, exactly.
Number 3, we get on a call like this, and the sales guy or woman says, Bruce, remember I was telling you about CRO? Ned, tell them what you guys do. Yeah. And then after that, the sales guy says, all right, so we're going to start this, next month, and we're going to give it a try for 3 or 6 months. Mm-hmm. And the client's like, oh, okay, well, that should be awesome. And that's it. Ned goes back home, they fill out the paperwork, blah, blah, blah. And Ned gets to do what Ned loves to do.
Yeah.
Right? Which is the A/B testing and to doing this and growing an organization and on and on and on from that standpoint. Other people that just need access to customers, can't build their own sales force. They're doing paid, they need earned, they're doing email, they need social, whatever it might be. And so when they see that and they see the role that they can play in an all-star team that's really financed and there's other smart people, that becomes really pretty compelling, from that perspective. And so the things that will drive value are EBITDA. It's always EBITDA, right, from that standpoint. How much of your business is recurring revenue?
Okay.
And what's your retention? And it was funny because I was talking to somebody the other day. We sold a deal a couple years ago, and our clients didn't have great, I'm going to make up numbers, but their retention was like 65%, way below market, right?
Yeah.
Turns out their cost of acquisition is really low. They're very good. They've got a bunch of social presence on and on.
Yeah.
So they just take everybody.
Yeah.
And they have a 3-month initial contract. And their philosophy is, listen, we make a little bit of money over 3 months, but we get to test with these people. We get to see if we like them and if they like us. If they pass that test, then retention was way beyond the market.
Yeah.
Much better. So when we did in the deck, when we talked about what our retention was, we measured retention based on day 91.
Yeah, exactly.
And the buyer said, well, you can't do that. And we said, yeah, we can. And let me explain to you why, though.
Yeah, exactly. Yeah, tell the story.
And by the way, when you own the business, if you don't want to, if you want to have full year contracts from the very beginning, you can do that. And I don't know what how much of your wins you'll get up front. I don't know what the impact of that'll be, but that's your decision. Yeah. But you should have an accurate picture of the business, because it's not a 60% retention business. It's more like an 88% retention business. Mm-hmm. And this is the farm club of how they do their marketing.
Yeah.
Ultimately, the buyer decided not to do that because it was emotionally draining on their people. Like, to lose that many clients, like, it's just not. And they had better salespeople at the bigger company, and they had a more mature process, and they had more service offerings, and it wound up being a great acquisition for them. Yeah. But having an idea on how we want to present the numbers so the company looks in the best light and all those kind of things, all that is important to making sure you capture the full value of the business.
Yeah. For listeners here that are in the kind of early stages of their company and starting to think about the exit process, when would you suggest they really kind of get serious about thinking about exit and exit strategy, and what are the things you suggest they start with?
So first of all, the Second Bite podcast is a great place to not listen to me ramble on, but to hear other founders talk about what their experience was like. Yeah. And that'll trigger a whole bunch of thoughts. Having your financials buttoned down by far is the most important thing. Mm-hmm. So you need to be GAAP compliant. You need to be accrued for properly. And if you've outgrown your first CPA or your accounting firm, get a legitimate one that can help put your business in the right perspective. And we've got plenty of things that we can share with people about A, who you might want to reach out to, and B, what your financials should look like. With that vision into your business, you understand your business a lot better. And anybody listening who's gone through that maturity process realizes how much better they are at managing their business with this data than what they've had. And then I would say, we sold this company here. It's called Worth E-commerce. And Dean, this is a few years ago. Dean's a great guy. They were about $920,000 of EBITDA. So a little bit below our mark. And they do email marketing for e-commerce customers only. This nice little box. Yeah. I showed that box to a whole bunch of people. And we got a great transaction for him. We sold them to SmartBug, which is a HubSpot partner. Mm-hmm. And it was a great fit. So if you're small But like the CRO business, this little niche like that, fantastic. We sold a company over the summer that does performance marketing for law firms. We've done that for elective medical. We've done it for different verticalization. If there's something that is a unique sliver that you offer, whether that's service or end customer or something of that nature, I would start to focus there. It's also probably a better way to sell and get more customers when you're an expert in who they are.
Yeah.
So a couple little things like that. I think the other things you don't worry about, right? Because we can adjust for those in your earnings when we do your financial workbook.
Yeah.
Right. So, I've got a group right now where they hired a director of sales and 3 salespeople, and it didn't work out, and they canned them all, and they're doing something else. Mm-hmm. And we added it all back. And yes, we'll be in a fight with the buyer over that, but the point is we don't have them anymore, and we don't need them anymore because we're doing it differently.
Yeah.
And if you don't agree, then you don't agree, and that's fine. Well, I just got to find somebody that will.
Someone does, yeah, exactly.
Yeah, there's plenty of people out there. Yeah.
Todd, this has been a pleasure. You mentioned the podcast. What else what other resources do you have or ways that people could get a hold of you and find more information about what you do?
Yeah, so we plot a bunch into the podcast, and that's really the best because it's live and it's everything else. So secondbitepodcast.com you can go to. Potomac Business Capital is our website. Mm-hmm. The podcast will take you there as well. I'm sure my contact information will be in your show notes, but people can reach out to me on LinkedIn. I'd be happy to, we talk to an awful lot of people.
Yeah, I'm sure.
And that's how we stay in the mix and stay current and stay everything else. So if somebody wants to talk and reach out and brainstorm, reach out to me on LinkedIn. I'd love to chat.
Right. I'll make sure that the podcast, LinkedIn, all those things are in the show notes so people can get that. Todd, always a pleasure. I really appreciate you taking the time today.
I enjoyed this conversation, Bruce. Thanks to you and thanks to your listeners.